All right, welcome to today's video, everyone. Today we're going to be talking about whether to invest in domestic or foreign deposits and why the answer is often not what you expect. So a little bit of background before we begin. A higher interest rate means you get more money tomorrow for your money invested today. So logically, sending your money to a country with a higher interest rate should mean you are securing a better investment, right? Let's walk through an example with real-life numbers where I, a rational investor, am choosing to deposit my money here in Canada or abroad in Mexico. So let's take a look at the Canadian deposit side first. Suppose I am investing $500 and can earn a deposit interest rate of 4.9% in Canada for 1 year. So let's build out our time diagram here. We'll start at June 1st, 2024, and we'll end 1 year from now at June 1st, 2025. Our interest rate is 0.049, and our principal is $500. We're going to need to accumulate this interest rate, this principal at our interest rate for the entire year. Remember, we do that by multiplying it by 1 plus the interest rate to the power of how many periods. For us, that's 1 period, since it's just 1 year. And we'll do that now to get 524.5, and that's how much money we're going to have a year from now. I will have $524.50 by this time next year, assuming the interest rate stays the same. This gives me a return of 524.5 minus 500 over 500 equals 0.049. Note that my return is equal to my earned interest rate for domestic deposits, and keep this in mind when we look at foreign deposits next. So now taking a look at the Mexican deposit side, the bank deposit rate in Mexico is about 4.8%. However, if I wanted to invest my $500 in Mexico, I would first need to convert my Canadian dollars to Mexican peso. The current direct exchange rate, which is the dollar price of a peso, is 0.08. Therefore, my principal investment in Mexican peso is 500 divided by 0.08 for 6,250 peso. So building our time diagram here for this, we'll start again with June 1st of this year and then with June 1st of next year. Our interest rate is 0.048, and our principal is now 6,250 peso. So accumulating this the same way we did before, the principal times 1 plus I to the power of 1, we get 6,250 times 1.048 equals 6,550 peso. And this is the amount of money we will have at this time next year. Now we can find out how much money I have in Canadian dollars by converting the peso back at the expected exchange rate a year from now. In 1 year, the CADMEX exchange rate is expected to be 0.09. So therefore, I will have about 6,550 times 0.09 for $589.50. And thus, my return is 589.50 minus 500 divided by 500 for 17.9%, which is not equal to the interest rate like the Canadian deposit was. So looking at some conclusions we can make based on this first example here. At first glance, we would think to invest domestically, since the Canadian rate of 4.9% is higher than the Mexican rate of 4.8%. However, we have seen that the Canadian deposit brings a return of 4.9%, way less than the Mexican deposit's return of 17.9%, meaning we should definitely invest abroad in this case. But why is this return difference so wide when the interest rates are so similar? To determine the reason for the higher return of the Mexican deposit, we can take a closer look at the exchange rates. But first, we can thank today's sponsor, Raid Shadow Legends, for sponsoring the video. So everyone, go download Raid Shadow Legends on the App Store. Alright, thanks, back to the video. Currently, the exchange rate is 0.08. In a year, it is expected to be 0.09. This means that the expected rate of appreciation of the peso is 0.09 minus 0.08 divided by 0.08 for 12.5%. This is the reason for the high return. Plain English, while your money is collecting very similar interest over in Mexico, the peso is also getting stronger against the dollar. So when they are converted back a year later, you can trade each one back for more dollars than you spent to buy them. For this reason, we can estimate foreign returns by adding the foreign interest rate and the expected percent change in exchange rate. In our case, it is 0.048 plus 0.09 minus 0.08 divided by 0.08 for 17.3%, which is very close to our return of 17.9%. This is the basis of the interest parity condition. The interest parity condition holds when the foreign exchange market is in equilibrium, which is when demand and supply for foreign goods are equal. The condition is the domestic interest rate must equal the foreign interest rate plus the percent change in the exchange rate, which is the exchange rate a year from now expected minus the exchange rate now divided by the exchange rate now. That is the point where an investor would be indifferent between domestic and foreign investment since the returns are equal. Very interesting. Smash like. In a perfect world, this condition always holds for any two countries. In our world, people do not agree on exchange rate expectations. Investors consider other factors than return, and some countries place controls on capital mobility, and this condition does not always hold. For that reason, we should build conditions that help determine whether to invest abroad or domestically. So looking at our investment decision rules, if the domestic interest rate is greater than the sum of the foreign interest rate and the expected percent change in the exchange rate, then the domestic rate is greater than the foreign rate after accounting for exchange rate changes, meaning domestic return is higher and you should invest domestically. If the domestic interest rate is less than the foreign interest rate plus the expected percent change of the exchange rate, the domestic rate is less than the foreign rate after accounting for exchange rate changes, meaning domestic rate is low, domestic return is lower, and you should invest abroad. If the domestic interest rate equals the sum of the foreign interest rate and the expected percent change in exchange rate, the domestic rate is equal to the foreign rate after accounting for exchange rate changes, meaning the returns are equal, and you would be indifferent between domestic and foreign deposits. So now you at home can make informed decisions on foreign investments. Here are the references for the numbers in our example from earlier. And thanks for watching. Make sure you smash a like, make sure you smash subscribe, smash like again. And yeah, that's all.